Hey there, and welcome. So, if you've ever pictured accounting as, just a pile of dusty spreadsheets and boring math, get ready to have your mind changed. We're about to crack the code and show you what accounting really is. It's the language of business. It's how a company tells its story, the good, the bad, and everything in between. So, let's jump in and learn the grammar, shall we?
So the big question is this: how does any company, whether it's a huge corporation or a tiny startup, keep that story straight? How do they make sure it's accurate and makes sense to anyone who needs to read it? Well, that's exactly the problem accounting was built to solve. All right, just like any language, accounting has rules. It has a grammar that holds the whole thing together. And believe it or not, it's all built on one single, simple, unbreakable rule. Get this down, and you've got the foundation for everything else.
And here it is in all its glory: assets equals liabilities plus owner's equity. This right here is the heart and soul of accounting. It's a perfect little formula that shows you everything a business owns, we call those assets, and then it shows you who has a claim on all that stuff.
The best way to think about it is like this scale. It has to be perfectly balanced all the time. The left side must always equal the right side. There are no exceptions. Every single thing that happens financially has to keep this scale level.
So let's look at that left side. What are assets? Well, simply put, assets are all the good stuff the company owns. We're talking about things that have value, like cash in the bank, equipment, buildings, or even land. Now, over on the right side, we have liabilities. This is basically what the company owes to other people. Think of it as claims that outsiders, like banks or suppliers, have on the company's assets. It's the debt part of the story. And what's left over? After you take everything the business owns and subtract everything it owes, that remaining piece is the owner's equity. It's the owner's personal slice of the pie, their claim to the assets. You could even call it the net worth of the business. Okay, so we've got the mean rule, the grammar. Now we need the tools to actually write the story. How do accountants keep track of all the financial comings and goings of a business every single day? Let's check out the toolkit. The process itself is really straightforward. It's a simple three-step dance. First, you record everything as it happens in a journal. Second, you take those entries and organize them in the ledger. And finally, you add everything up in a trial balance to make sure it all, balances. Let's start with the journal. I want you to think of the journal as the business's diary. Every single financial event, a sale, a bill payment, buying supplies, it gets written down in here first, in the exact order it happened. So if the journal is the diary, the ledger is like the super organized library. It takes all those diary entries and sorts them onto different shelves. All the cash entries go together, all the sales entries go together, and so on. This way you can see a running total for any specific category at a glance. Okay, deep breath. We're heading into the one area where people sometimes get a little confused. But I promise you, it is so much simpler than it sounds. It's time to finally decode the real meaning of debits and credits. First things first, I need you to forget everything you think you know about debits and credits from, like, your bank statement. Just wipe it clean. In the world of accounting, it's so much simpler. Debit just means left, and credit just means right. That's it. Seriously. Left side, right side. End of story. And this is the absolute key to understanding everything. Debits aren't good or bad. Credits aren't good or bad. They're neutral. Their only job is to increase or decrease an account, and how they do that completely depends on what type of account we're dealing with. And this picture shows it all perfectly. Look at assets on the left side of the equation. To make an asset go up, you use a debit, a left side entry. To make it go down, you use a credit. Now look at the other side, liabilities and equity. It's the complete opposite. To make them go up, you use a credit, a right side entry. And to make them go down, you use a debit. This beautiful little system is what keeps that scale perfectly balanced no matter what. And here it is, all laid out for you. This is your cheat sheet. It's that simple. Assets and expenses go up with a debit. Everything else on this list, liabilities, equity, and revenue, goes up with a credit. And see that normal balance column? That's just a fancy way of saying an account's balance usually lives on whichever side makes it increase. It's beautifully logical. Okay, enough theory. The absolute best way to really get this stuff is to see it in action. So let's take a couple of basic transactions and see how these rules actually work in the real world. All right, scenario one. Imagine you're starting a new business and you put $30,000 of your own cash into the company bank account. So what happens? What two things just changed, and how would we record it using our new debit and credit rules? And here's the answer. The business just got more cash, right?
and cash is an asset. Our rules say assets increase with a debit. So, boom, we debit cash for $30,000. At the exact same time, your claim as the owner, your equity, also went up. And our rules say equity increases with a credit. So we credit owner's capital for $30,000. A debit and a credit of equal value. The scale stays balanced.
Ready for another one? Okay, now the business takes $20,000 of that cash and uses it to buy a piece of land. So what's the story this time? What came into the business and what went out?
So did you figure that one out? The business gained a new asset, right? Land. To make an asset account go up, we debit it. So we debit land for $20,000. But to buy it, it had to give up something. It spent cash. Cash is also an asset, and to make an asset go down, we credit it. So we credit cash for $20,000. See what happened? We just swapped one asset for another. The total amount of assets didn't change at all, and our equation is still perfectly balanced.
I think you're starting to see the pattern here, right? Every single financial event, no matter how complicated, gets broken down into this simple two-part entry, a debit and a credit. And it all works to keep that main equation in balance. But why are we doing all this? Well, it's all about building to the big picture.
Because every single one of those entries is like a single pixel in a giant photograph. By themselves, they don't show you much. But when you put them all together, day after day, they build a rich, detailed picture of the business's health. And that picture gets summarized into reports that help people make really smart decisions about the future.
So we've seen that accounting isn't just about numbers. It's a language with its own grammar and its own rules, all designed to tell a story. So I'll leave you with this question. Now that you know the basics of the language, if this were your business, what story would you want your numbers to tell?